Hi, everyone. So thank you very much for being here at the end of the day when we're the only thing separating you from your drinks, a fact of which we're acutely conscious. So we're going to try and make this as entertaining and interactive and as engaging as we possibly can. So my name's Jana Pache. I am an executive director and the policy lead for the Digital Pound Foundation. We are a not-for-profit trade association that advocates for the introduction of a digital pound in both publicly and privately issued forms, something we'll discuss in a little while on the panel, and a diverse, effective, and competitive ecosystem for new forms of digital money in the UK. And would you like to introduce yourselves?
Yeah. I think this works. Yeah. So I'm Andrew Whitworth. I'm policy director for EMEA for Ripple. Ripple is a B2B blockchain tech service company. We work mainly in the cross-border payment space. Do a lot of work both with private and public forms of digital money. I'm also the chair of the Blockchain for Europe Association based in Brussels. So we have a lot of these similar conversations in the European context as well.
I'm Keneze Giokoi, co-founder and co-CEO of Millicent Labs. We're a blockchain-enabled fintech company building infrastructure for tokenized fiat money. I'm also currently sitting on the Bank of England's CBDC Technology Forum.
Hi, good afternoon, everyone. I'm Rami Solomon. So, yeah, I'm the co-founder and policy lead of Stablecoin Standard. They're a industry body for stablecoin issuers globally. And my day job, I'm president at GMO Trust. We're a New York regulated stablecoin issuer, issuing a dollar stablecoin and a yen-backed stablecoin. So certainly a link to the subject matter of what we're talking about.
Thanks, everyone. So before we get started, let's just get a sense of the level of knowledge in the room. Who here is comfortable in their understanding of what a central bank digital currency is? Hands up. Okay, this is pretty good. And who here is comfortable in their understanding of what a stablecoin is and how it differs from other forms of money? Okay, I recognize some of you. Right, well, so the purpose of this panel is really to explore what these new forms of digital money are and what the kind of future ecosystem of digital money is going to look like. So to get started on this, Andy, to start at the very beginning, what is money? And what's the difference between the money we have today and what the Bank of England refers to as new forms of digital money?
Yeah, well, thanks. I've not this question. What is money? 5,000 years or so. Hopefully the same answer, at least if you believe The Economist, which I do. So, I mean, famously, I think, and maybe in the room know, money has three functions. It's a store of value, it's a means of exchange, and it's a unit of account. At different times, people focus more on one part of this or the other. But traditionally, something needs to have all three of these functions traditionally, well, again, that's very different. Traditionally, something needs to have all three forms of this, all three functions of this to count as money. Well, that's gone through the back. Yeah. To count as money. I think when it comes to the debates we're all having today, we've seen how this has played out, with people focusing one part more than the other. So, you know, when talking about stablecoins, is often thought about as a means of payment, but also often thought about as a unit of account, a store of value. What I think is quite interesting, and obviously, you know, Bitcoin people talk about this all the time. What I think is quite interesting is this unit of account function, because we often forget about it. And the more I think about it, the more this is where the sort of relevant definition of money comes from. So if you think about it, when you're paying for something, particularly in the modern world with fiat, where it's not linked to gold or it's not linked to anything else, of course we all know you're just paying with something that other people have accepted they will accept on behalf of something, because it has a certain nominal value. And obviously, you know, we're well aware of what's going on with inflation in various countries and things like that, where the nominal value can separate out from the value of the goods underneath, and you end up with different prices, things like that. Now, what I think is interesting when it comes to the digital, the idea of digital money, these future forms of money you're talking about, is that what we're seeing is different types of this, be it crypto asset, be it stablecoin, be it tokenized deposit or CBDC, targets different functions of the traditional uses of money. Where I think we're at now compared to where we were whenever it was, 10, 12 years ago, when this whole sector first started, is I think the question of unit of account has been settled definitively, and settled definitively in favor of fiat definitions of money. If you think of somebody, in the days when these existed, called a Bitcoin billionaire, that didn't mean they had $1 billion Bitcoin. It means they had $1 billion worth of Bitcoin or pounds or whatever. Similarly, stablecoins, when you think of Libra as the first one to come along that was going to be backed originally by a basket of currencies, and was going to be worth 1 Libra, that was whatever it was worth around the world. Now stablecoins are very much backed by a single currency. They don't have to be, but they are, or they do tend to be, although you can very well correct me if I'm wrong. And in a sense, they are piggybacking off the unit of account function of a fiat currency. So I think what we're now talking about when we talk about different digital forms of money and their interaction with traditional financial sector is, where does the technology that we have, blockchain usually, where does that help for the different functions, the store of value or the means of exchange? And I think what we're seeing is these different types, as I say, CBDC, crypto assets, stablecoin, tokenized deposit, they have different benefits, different costs, different trade-offs. Some of these, in a sense, are operating in a different financial world compared to traditional financial fiat monies. And what we need is an on or off ramp between the fiat world and the digital asset world, digital money world. Some of them are replicating the fiat world on, or trying to replicate the fiat world on chain. I think that's where I'd place stablecoin, where I'd place CBDCs, maybe tokenized deposits too. So they have different functions, different benefits, different costs, different trade-offs. When it comes to looking to the future, to me, what matters, therefore, is the transparency to understand what are the different characteristics of these different forms of digital money. The education, so people get it, so they know what they're getting, they understand what that means. And then the interoperability between them. So can you move between one or the other? Now, there is a bit of a debate about whether that needs to be total free interoperability at all times. I tend to think it does. You could say, well, actually, if you know that a bank deposit is stickier than cash in your wallet, and everyone theoretically does know that, actually, does it matter? If a digital form of money has different characteristics, they're not perfectly always interoperable or convertible, frictionless between one and the other. As I say, I think what matters is that they can ultimately be exchanged for each other, that people know what they're getting, and they understand what the trade-offs of these things are. Ultimately, I see, certainly Ripple, my company, sees that in the future there will be a mix of different types of money, physical, digital, private, and public. And really what matters is that the firms in this space work together to create a space where consumers or end users, whatever they may be, understand what they're getting and know how to move between this in a coherent way.
Thank you. And you touched on a few interesting points there. First of all, you've begun alluding to the difference between public and private money and the different roles that these different kind of types of issuance can play. Kene, would you like to expand a little bit more on public versus private money, what that landscape looks like today and what that landscape might look like in the future with new forms of digital money?
Sure. So you can think of money as being a claim against an institution, whether that's a public or a private institution. It's a liability of that institution. And so you deposit your £100 at the bank, and that bank now owes you £100. What they do with your money in the interim is not really of your concern, so long as you can take back the £100. At least that's the argument that they make. Now, the central bank, as the lender of last resort, or as the creator of money, is the public sector side that creates that unit of account, store of value, medium of exchange, etc. And according to the prevalent thinking from the BIS and many of the central banks, it is that publicly issued money that's the glue that holds together the other forms of money in the system. Because a bank deposit is not the same as e-money, but even more so, a bank deposit from Lloyd's technically isn't the same as a bank deposit from Barclays, because one is a claim on Lloyd's, one is a claim on Barclays. And whether we know it or not, somewhere in the back of your head, you know that you can take your card and go to the ATM and withdraw £100 in central bank money, in risk-free public money. And that is what, to Andy's point about the convertibility of money, holds the entire system together. So the argument has been made that What we need to move into new forms of digital money and make them interoperable with one another is a form of digital public money that we can use as the backing asset and therefore the glue to hold together what the BIS calls the singleness of money or the unity of money. And right now, with a lot of privately issued forms of money, they aren't backed by the same reserve facility. So the different institutions, Rami stablecoins with, say, a Circle stablecoin or a Tether or a DAI, etc., might not be convertible one-to-one. They might trade at a few bips. A merchant who wants to accept different forms of privately issued digital money almost has to do a little bit of due diligence to say, actually, I will accept Circle and I will accept GUSD, but I won't take Tether and I won't take DAI. And if you're, I don't know, Costa Coffee, and there are 100 USD denominated stablecoins, how do you decide which ones you take? You don't. You accept the most popular ones, which creates a huge market concentration that we haven't actually seen in today's system. So we started out with the blockchain thesis of let's get maximally decentralized. And we've almost reverted. Today in the UK, you've got 500, 800 odd banks and building societies. They can all issue pounds that are interchangeable, but we can't yet do that on the blockchain. And bringing public money on chain might allow us to do that.
And Rami, you are pretty much immersed in the stablecoin world. You're both a stablecoin issuer, well, not personally, but your company is. And you are a founder of the Stablecoin Standard Organization. So what do stablecoins introduce to this mix of privately issued money? How do they differ from commercial bank deposits, for example? What are some of the different risks and regulatory considerations and things like that? And do you think that they're actually money?
A very good question. Thank you very much for that, Jana. I want to take a step back and think about the end objective and end outcome for these various products, because I think that stablecoins and other digital products that are out there, the menu of digital products, serve different outcomes to a different audience. So Andrew and Kenny have quite clearly talked about CBDCs and digital money as an evolution of the current system, using central banks as the lenders of last resort and digitizing that process. Stablecoins, I think, were actually formed as they are at the moment, are the winning use case of crypto, and they service a crypto-centric ecosystem, and they're also 99% dollar denominated. So when you mentioned the definition of money for stablecoins and digital money has sort of gravitated towards the fiat-backed definition. That's where we're heading with stablecoins. How do they differ from commercial bank creation money? They're early, I think, and they haven't got regulatory clarity. I think that's the problem that we have. That has actually stifled their growth and adoption by the institutions. So, for example, I set up a stablecoin issuers industry body only a year ago, and stablecoins have been around for many, many years because there wasn't anyone to engage on behalf of stablecoins as a collective. You look at regulatory progress. Certainly, I'm regulated in my day job with GMO. We're regulated by the NYDFS. In fact, we occupy a quarter of the green list. So we're 2 out of the 8 stablecoin, 2 out of the 8 tokens that are actually NYDFS approved. So, we occupied a very highly regulated space, but no one's heard of us because our market cap is not so high. And, I guess market cap doesn't fill a credibility gap, if you know what I mean. I think that's the issue that we're grappling with at the moment. So the state itself is very politicized. There's not much regulation, or, it's become very politicized. So we're not going to get clarity there. We have Europe taking the lead with regards to MiCA. I think, the definition of payment tokens, e-money tokens, and asset reference tokens, I think is actually very helpful. And I think that can let stablecoins grow in terms of their profilation within institutions. Singapore is doing very well with regards to it. It's actually clarified stablecoin really, really clearly, so I think they're going to do extremely well. But I guess coming back to the difference between your original question, so the difference between stablecoin and, say, commercial money. So commercial money is fractionalized money. It's someone deposits, say, £100 into a bank. A bank is has a prudential regulation around it and can issue, 10 times that much to there. So it's fractionalized reserve. But again, because of the singleness of money, people can generally have a claim against that institution. And of course, if you're in a jurisdiction like the UK, you've got £85,000 as an individual that protects you. So there's a lifeline there. With a stablecoin, generally, if they are reserved or fully reserved, then it should be 100% backed, and that's a really important difference. A lot of people talk about the risk profile of digital products versus, say, stablecoins, and the BIS itself, within its latest publications, always sort of poo-poos a little bit stablecoins in favor of other forms of digital money because of the failures of some of the bad actors recently. Depegging and so on has happened, but the product itself is actually, when enabled and executed by good actors, is actually a fully reserved 100% backed product, which ironically should make it slightly safer than other forms of digital money if executed correctly and given the regulatory framework in order to help it establish itself correctly.
I noticed you've very judiciously used some caveats there around, if executed properly and with the right regulatory framework, because after all, most stablecoins at the moment are backed by reserves or assets that are held with banks or other types of custodian. And so they're exposed to that level of credit risk as well, but consumers are not protected in the same way. So, for example, if your bank goes bust, you are protected up to the FSCS limit of £85,000 in the UK. If your stablecoin issuer goes bust, not only at present do you have no recourse to anything, but
well, I would say actually for our stablecoins, so they're NYDFS approved, and our mandate is that they have to be held in FD. The cash has to be held in US banks and FDIC insured banks as well. So it's a difficult claim for pass-through insurance to be given to customers of stablecoins, but there is some recourse with the right issues.
So, and also, I guess, at the moment, the stablecoin issuer has no big recourse to the banking institution if it goes bust, which is a situation we have seen, crystallize in the US with Silvergate Bank. But what, in your view, would be the ideal sort of regulatory framework or, overall legal framework that could address some of those issues and enable greater user trust in stable coins?
That's for me. So I think, the FSB came out with some principles, and one of the core recommendations of the most recent was global harmonization and global coordination across different regulatory bodies. So I think harmonization and agreement on some basic principles, even the definitions, would be quite useful. I think that would be helpful because everything trickles down from there. Once you get the definitions correct, you're able to then pass sensible principles-based regulation. We talked about earlier, the FCA were on a panel, and it's about, same outcome, same regulation, same principle. So if we can take that mindset, but it starts from correct definition and correct understanding of the mechanics of the product, I think that would be useful.
Okay. Anything to add before we move on to CBDCs? Yes.
So I mean, just on that last point around the same activity, same risk, same regulatory outcome. I mean, obviously we all agree with that. I think sometimes, and that's used often as a sort of shorthand of saying tech neutrality, or public institutions have tech neutrality as an objective, which is interesting and I would personally consider correct. But it does presuppose same activities, and actually is a stablecoin doing the same thing as a bank deposit? Now, I'm not going to go back to my previous speech around store of value versus means of payment, but I think I'm right in saying that most stablecoins are used for payment. That's very different to storing your money in a bank account. So I think the mantra of same activity, same risk, same regulatory outcome is correct, something we will support. But I think there can still be more thinking around whether these are actually the same activities, or what is the same activity that we're talking about here. You often hear certain traditional financial actors, essentially arguing for the extension of the prudential regime for banks to new, digital institutions, digital firms. And in some places that might be correct, in some places it may not, because as you say, or as you said, I mean, they're not doing fractional reserve banking. Actors in the space are not creating credit in the same way that that a traditional bank is. So there are very different risks to the financial stability, to the wider economy, and to consumers. So I think we need to be a bit careful when we sort of apply the mantra of same activity, risk, and regulatory outcome.
Thank you. So let's talk about central bank digital currencies. And maybe let's start with the why for central bank digital currencies. So before we start to explore the digital pound and maybe touch on the digital euro in a little bit more detail, the House of Lords Economic Affairs Committee famously in January 2022 produced a report on CBDCs and concluded that they were a solution in search of a problem. Now, there were potentially, the scope of that was fairly narrow and things like that. But why CBDCs? Why why is the UK exploring one? Why should the UK be exploring one? What is the case for it? Are they actually useful in any way?
I think why CBDCs as a first principle can be answered with one word, and that's Libra. Because the central banks got scared of the technology and of a big tech firm with 2 billion customers, so twice the biggest country on the planet, was going to introduce their own money, and they would have lost control of monetary policy. And so CBDCs, the ramp up we saw so quickly in CBDCs was a bit of a knee-jerk reaction. But I think that we've moved on from that now, and we're now looking at ways that CBDCs can be integrated with broader forms of money or the broader monetary system, and can really help to modernize payment systems in countries where they're lagging behind. And that's not to say that retail CBDCs, or I know that we've spoken about not really liking this distinction between retail and wholesale CBDCs, but that's maybe another rabbit hole. But behind the scenes, they can enable settlement, they can enable new forms of money to be held together, I think, and more accessible to more people.
Yeah, I mean, if I can jump on that. So, I mean, I agree. And I would say, I think the public policy use or reasoning for a CBDC is quite clear. Or there are many of them, whether that's upgrading the innovation system or the innovating for the payment system, of the domestic financial system, or whether that's to improve financial inclusion. Ripple does quite a lot of work with central banks around the world to help them figure out what they want to do with a CBDC, do some pilot projects, help them understand the technology. For a lot of these central banks, and these tend to be in emerging economies, it is about financial inclusion. Like we have one famous pilot with Palau, this is not a plug, but they've got many islands, and until very recently, they had to physically ship in ships cash to each island. Now that's difficult, dangerous, expensive, inefficient. So they're very interested in developing some kind of CBDC, or in their case, because they're dollarized, sort of stablecoin solution. So you can see that there are benefits. Now, maybe these aren't all the same benefits in each country. So again, it goes back to the point of, well, what do you want it for? What do you need it for? But I think there are public policy benefits. The bit I still have a bit of a question around is what the retail use case is. I mean, or use case for retail users. And I think a lot of central banks I know they are thinking about this. The DPF is thinking about this. They have a very good working group on use cases. They exist, but they can be quite niche. And if the idea is to get mass adoption from the public in a developed economy who already have payments on their phone, digital payments, online payments, that could be quite difficult, because coming up with a plethora of, how many hundreds of individual use cases is not the same as saying, well, actually, digital contactless payments, they took off when you could use it on the tube in London, in the UK, right? Mm-hmm. I don't think we've seen or we've worked out what that killer use case is for CBDCs in a country like the UK. And maybe we don't need one. And personally, I'm quite taken by the Bank of England's approach of saying, look, we're doing this to develop the infrastructure. In the future, the private sector will innovate on that. Partly that's kicking the can down the road and passing the buck, fine. But also, I think if you look at, and I'm sorry to get very technical here, but if you look at the PSD2, so the Payment Service Directive, the second Payment Service Directive in the EU, which came out 5-6 years ago, That, I would argue, has created the fintech and payments PSP landscape that we know today. It wasn't intended to, but it has done. I think a CBDC might do something similar.
Yeah. Actually, building on that, what Andrew said, so PTSD, not PTSD, that's post-traumatic stress disorder, but we've all got that now from crypto, but PSD3 is coming in, and interestingly, it allows for non-banks to access the European payments infrastructure, which is actually very good for private stablecoin providers to be part of that settlement framework, which actually could be the catalyst to help things proliferate again within there. But, to your earlier point, it's in developed economies, it's a solution in looking for a problem. I agree with the panel in the sense that I don't see a massive short-term use case manifesting itself for CBDCs or retail CBDCs when money works pretty well here. I think we're all able to pay for goods and services using a variety of different methods. And as far as the front end of the operations, it all works pretty well. Behind the scenes, of course, there are innovations, and I guess we can all agree that with tokenized deposits adding into this, the technology itself is transformational, and it's a vindication that the fact that we're talking about all of these different forms of money means that the technology has been, it's vindicated as a step forward in what is already there. So, like the Bank of England said, there may not be a use case that manifests itself immediately, but it's good to keep up with the technology, and I think that's the right attitude. Where stablecoins are a bit more versatile and quicker moving because they're privately issued is use cases in other countries, so the developing world, the global south. I was in Argentina, earlier on this year, and if it's a quasi-dollarized economy at the end of the day, and to your definition of singleness of money, it is a store of value. They are using it as an inflation hedge. Think about sort of Argentina, Lebanon, Egypt as a currency. A CBDC of any of those denominations, currency or peso, would not be a very useful thing for the end population in those countries. So stablecoins and other digital forms of money do have use cases. They do allow for aid to be sent in a more transparent way than cash. There was the Stellar Aid Assist program last year, which was quite interesting, sending dollars to Ukrainians just using a mobile phone, which is fantastic. So that, you think about LATAM or Africa, where a lot of the world is unbanked. So actually financial inclusion from a central bank is it doesn't make any sense anyway. So you just need to give those people the access to buy goods and services, to exchange, different things with the population of that country, using a currency that isn't going to halve in value in a week. So that's the rationale behind the use cases, and why the catalyst is actually going to be happening outside the G5 or G10.
And that Stellar example is actually really interesting, because that is an example of a use case that couldn't be achieved using a CBDC, at least in any of the currently envisaged forms, because it involved value crossing multiple borders and having a payments infrastructure in place that supported all of those. Going back to the use case point, arguably there's an argument to be made that the very existence of stablecoins and use cases for stablecoins means that there are use cases for CBDCs as well. The question is probably more, is there a unique use case for CBDCs that cannot be fulfilled by a privately issued form of tokenized money, be it a stablecoin or a tokenized deposit or anything like that? Or is there a unique function that a CBDC can fulfill that none of those private issuances can fulfill? Kenny, what are your thoughts on that?
Well, throw me under the bus, Jana. Well, I think one thing that Rami was saying that's interesting is, people in what are notionally non-dollar countries are saving dollars, and stablecoins are 99.5% denominated in dollars, and they're really helping to export dollars around the world and removing some of the monetary policy choices from jurisdictions. And some may be too far gone, and I agree, if you live in a country with a rapidly devaluing currency, of course you want to hold a more stable currency, and that should be your right. But where's the tipping point? You know, if we give everybody access to always on dollars all the time, and we don't give them any kind of alternative that's useful, does the world just run on the dollar? Because that's the way that it's moving if we go like this. So maybe a CBDC is a way for some of these central banks to stem the tide. And that is the use case that they're looking for, is to be able to enable all of the technical advantages that you get from a stablecoin or from programmable money that's, you know, easily, cheaply sent and always on, but still protects their monetary policy levers, so they can, you know, change interest rates and try and rein in inflation, or try and distribute aid in their own country, in their own currency. And that's maybe one of the problems that I have with, let's say, stablecoin proliferation. I don't have an answer for it, but that's a big reason behind, I think, CBDC thinking. And I'm sure Andy's got some thoughts on that.
We really are just passing the bars. Yeah. Anyway, yeah. Well, I mean, for me, who are we kidding? The difference between a CBDC is the link to the state, public sector, central bank, how you're going to call it. Like, that is a fundamental difference, and whether you think that's a good thing or a bad thing will depend on your politics. And a lot of people, particularly in the Web3, blockchain, crypto space, has different politics to people in traditional financial space. I think a large part of the conversations we will have is precisely around that outlook on the world. So, you know, that's good, because if you think the state is powerful and has your best interests in heart, then you think the link to the state will make it safer, or ultimately be a place you can run to if there is risk in the financial system, in your bank deposits. If you think the state, or if the state you live in is less benign, or you're less confident in it, then you think that the CBDCs linked to a state I assume you would think that would be a less desirable thing. So I think, in a sense, we're moving beyond the use case, design, function question here into a broader one, a political economy, which we'd like to talk about, but maybe more over drinks afterwards. I think that's the first point. The second point is, I do have some sympathy for central banks when it comes to stablecoins, perhaps kind of what you were alluding to, Kenny, because, you know, I don't know if we want to see a world in which every country's economy is ultimately dollarized. I don't say that because I have any problem with the United States, not at all. But I think if we think that individual states of individual nations have the duty and right to do what they think is best for the needs of their citizens, well, independent monetary policy is a pretty large plank of that. It's up to individual countries whether they want to exercise that or not. But I think it is right that there should be some framework that should allow them to manage this in the way they think is best. Now, that framework could be regulation on stablecoins, it could be on limitations of foreign stablecoins, it could be on creating a CBDC. Probably some mix of all of these, right? But I think it is perfectly correct for states to have this kind of role in managing the development and the flows of this kind of potentially extra sovereign form of money in their own economy.
Yeah. Building on what the guys have said, and absolutely, I agree with it. I think it ultimately actually comes down to a function of trust. How much do you trust the central bank of the entity, the country where you live? And really, everything will be dictated by your answer to that. If you do not trust that government, then why would you trust a CBDC denominated in that government? And you would look, and the market will dictate an alternative, which they will gravitate to, which at the moment is dollar-based stablecoins. That's what the market has defined. And you know, stablecoins are not the reason that weak economies and weak currencies fail. You know, Zimbabwean hyperinflation, it happened well before stablecoins came on the scene. So, you know, they may accelerate it in other jurisdictions, but yeah, I don't think there should be a conflict. It's a trust issue at the end of the day.
Okay. I did say this would be interactive. So before the panelists close with their thoughts on what that future ecosystem of different forms of digital money coexisting will look like, do we have any questions from the audience? Okay. Yes.
I was just pointing to the screen, sorry.
Oh, right. Sorry, I didn't see the screen over there. Okay. Right. Good question. On a bridge over the M1 motorway, there's a large graffiti saying no to CBDCs. Will governments struggle to bring the population along? And I think this is very topical because the Bank of England did receive over 50,000 individual responses to its recent consultation on the digital pound, many of which were probably boilerplate and downloaded from various, special interest groups and things like that. But it does seem that CBDCs have galvanized a certain segment of the population in the way that few things have recently. So if a CBDC is to be successfully introduced and adopted in the UK, what are the steps that the Bank of England and policymakers need to take to bring the population along on that?
I mean, not to be facetious, but it's not that governments will struggle to bring the population along, it's central banks will struggle to bring the government along. Because before, I think every central bank is very clear that given the sort of retail impact this a central bank digital currency as envisaged could have, they want parliamentary or governmental approval of this and to go through the legislative process. So the real challenge is for a central bank to develop something which they can then sell to the government and parliament. Then there'll be a next stage argument over, or discussion over why individuals will want to use it or whether they accept it or not. Although you might think, hopefully in a representative democracy, that the discussion in Parliament would itself go in some way to answering that second stage.
I think there's also it's become a proxy for a freedom sort of movement. I don't want the government to track how I spend my money. If I take £10 out of the cash point, I can spend that in whichever way I like, and the government's not going to know what I've done. But it doesn't take account of the facts that so much money is happening, so much money transfer is being tracked anyway because everyone uses their cards and their Apple Pay and everything else. So everything is actually being tracked already. So the amount of actual cash in the system that's actually moving around doing illicit or hidden things or preserving freedom is actually a minuscule amount, I believe.
Okay. And a question probably closer to my heart, actually, is would a killer case for CBDC be tokenized traditional asset exchanges and DeFi once these start? I guess there's a broader question to be asked here in terms of the role that CBDC in a secure wholesale settlement asset with zero counterparty risk has to play in the development of digital asset markets and potentially cryptocurrency markets as well. Would anyone like to comment on that?
I did ask the question to both the FCA and the bank, could I wrap a CBDC and, stick it into Aave? And I didn't get an answer from either. They kind of and moved on, which is understandable, I suppose. But I think we will see a lot more DeFi-like use cases move into the regulated space, and those lines will start to blur. And when you've got programmable, instantly settled backing asset, it unlocks a lot of efficiencies in the system. And I think much like the iPhone, when it started, the first app was like the beer drinking app. It pretended that you drank a beer, and now you can't live without your iPhone because of all these use cases that you didn't know were going to be developed. So I think we'll definitely see some of that come out in the years to come, if and when we do get a CBDC.
And there's a question here as well, and is the use case for stablecoins just a stepping stone until CBDCs become widely developed and used? And I think that can kind of lead on to a good concluding question for everyone, which is, what do you see the future ecosystem of money in general, not just digital money, looking like? Will one form ultimately dominate or supplant another, or will we see some kind of coexistence? And is there likely to be some sort of shaking out of different forms of digital money? What's your vision of kind of what's going to happen in the next 5 years and what that ecosystem will look like in the future? And we'll start with Andrew.
Oh, thank you. So, I guess I alluded to this in my opening remarks. I fully believe that we will see all these forms of money in the future, including cash, including commercial bank deposits as we know them today, including e-money, which I didn't bring up, which is very similar to stablecoins in many ways. In many ways. And then also the stablecoin, CBDCs, tokenized deposits, and crypto assets as well. As I said, ultimately, I think these are all ways of transferring value from one person to another. Now that may be over time, so from yourself today to yourself in the future, could be to another person in the form of a payment today. Ultimately, they're all forms of all money. Everything we're talking about is just a different way of transferring value. How much does it cost you to do that? How easy is it to do it? How traceable? How redeemable? well, the ways around it, that's what we're discussing here. I think what's interesting, and very much to Rami's point, is that the technology has caught on. What we're discussing now is the business case behind the technology for different forms of institution, public and private.
Yeah. And there's also another question on the screen, like, will a person in the street first notice after the government's issued a CBDC? I think in the future we'll have a lot of different forms of money, and the average person will have no idea, just like today, people that use Monzo don't know that it's different from the money that Revolut holds. At the end of the day, we want to be able to pay for things and make our lives easier, or not even have to think about this stuff. We're a bit nerdy and like to talk about this stuff on stage. Most people don't and shouldn't care. And I think digital money will be just the same, an enabler of better outcomes, and that's it.
Yeah, I absolutely agree. I think that, the spectrum of money as it exists now, from cash and coins all the way up to the various forms of digital money, are all going to exist because the world is not harmonized. They're all at different stages of their evolution and have different localized or geopolitical problems. So all of these forms of money are going to exist. I do think that certainly from the stablecoin perspective, there are going to be many iterations. So I think the issue is what will be the development will be who's going to be issuing the stable coins and the credit quality of the stable coins and their backing. And that will be sort of a catalyst for better regulation, and all that kind of stuff will move there. And I certainly see a world where CBDCs and stable coins coexist, and tokenized deposits. They are all serving, they're all based on the basic technology, which we agree that is a step forward, but they serve different purposes, and I think they can all coexist. I can certainly see a stablecoin being backed, reserve backed by a CBDC, for example. I think that's a natural evolution in a few years.
And we're now officially out of time. So thank you to our panelists, and thank you very much to our audience for staying this late.